And welcome back. As mortgage rates have been increasing, demand for mortgages sank big time last week. This is according to a new report that was actually just announced today, which is October 12th, from the Mortgage Bankers Association, or the MBA. This video took me hours to make because of all the research I went into making this video. So I'm going to be sharing some trends we're seeing right now in the long term that's not even mentioned in this report here, but it's based on my own analysis of their data here. So hope you guys appreciate that. So with that said, let's go ahead and dive right in. I have so much to share in today's video, some pretty eye-opening trends regarding our housing market here in the US. So again, this is according to the MBA as of the 12th, and this is for the week ending October 7th of this year. This is based on a survey for weekly mortgage applications, which of course includes refis plus purchases. So overall, total mortgage applications decreased 2% from 1 week ago. Of course, this includes refis plus home purchases though. So this is what's called their market composite index, which is this number right here, the 2% decline. So if you actually read this, doesn't sound too bad, right? Only a 2% decrease from 1 week ago. But have a look at this, because here's my note right here. Total application volume, which again is their market composite index, has now fallen to its slowest pace since 1997. Which is pretty eye-opening here. Obviously, this is the main cause of this is due to a fallout in refis because of a rise in mortgage rates. So look at this. The refi index decreased by 2% compared to the previous week, but was down 86% from the same week 1 year ago. Now, it's not too surprising we saw this giant decrease in applications for refis compared to 1 year ago, given the run-up of mortgage rates, right? And also, this is the biggest year-over-year decline of refis ever since October 1999. And again, obviously the fallout of refis is due to rising mortgage rates. And here's the latest trends we have regarding that right now. The 10-year US Treasury note, the yield right now is actually just under 4% right now. Again, this is tied very closely to mortgage rates. And also, according to the Mortgage News Daily, as of today, rates are, let me go back, rates right now are 7.14% for the average 30-year fix for people with exceptional credit, unchanged from yesterday, by the way. And when you look at the trends over the past year, though, rates last year were 3.20%. So again, rates have increased about 4 percentage points from 1 year ago. So obviously it makes sense that because rates have increased more than 2 times compared to 1 year ago, it makes sense we're seeing this fallout of refis. And here's an actual chart for regarding refis as well. This is also on the Mortgage News Daily's website here. They pull data from the Mortgage Bankers Association based on their weekly surveys here. So look at this. The orange line right here is the average 30-year fix. Let me just get rid of the refi index for right now. 1 year ago, according to them, actually not 1 year ago, sorry, 5 years ago, rates were at 3.94%. 1 year ago, less than around 3%. And now they're over 7% right now. So take a look at this. Here's a refi index. Let me just add that right now. Look at this. The refi index absolutely skyrocketed in March 2020, basically the onset of the pandemic, when rates were about 3.36%. And look at this, back in February 2021, back in January and February 2021 was the all-time record low for mortgage rates, around 2.7%. And their index at that time was 4,549. I want to mention this because look at what's going on right now, because their index right now is only 430. So they went from over 4,000 now to only 430. So their index has absolutely been tanking over the past couple of years. And again, this is an index based on the total number of people submitting loan applications for refis. And going back to the MBA's report here, here's some other trends I want to share with you guys regarding demand for home purchases, or demand for loans for home purchases. This is based on their unadjusted purchase index, which also decreased by 2%, same for the refi index, but down 39% from the same week 1 year ago. Obviously, that sounds like a big number, right? But based on my own analysis here, check this out. This is the lowest level we've had since October of 2015. On top of that, their unadjusted purchase index has now declined in 12 out of the last 15 weeks. But wait, there's more. And by the way, this is not mentioned in this report here. This 39% decrease compared to 1 year ago is also the largest year-over-year decline since September of 2010. So let's briefly recap here, because the demand for applications for home loans has been absolutely tanking this year. of course, due to rising mortgage rates. So let's recap here. Here's my notes right here. Mortgage applications for home purchases has now decreased 12 out of the last 15 weeks. On top of that, the purchase index has now sank to its lowest levels since October of 2015, a 7-year low. And again, the 39% decrease on a yearly basis here is the largest year-over-year decline in purchasing demand since September of 2010. And here's a chart showing their purchase index over the past year. So right now, their index right now is 170.5 and has been more or less declining ever since the end of January, January 31st to be exact. The index right now at 170.5. Take a look at this because going back to 2015, this is at the lowest levels since October of 2015. In any case, going back to the report here, hope you guys appreciate all that data there because it's not even mentioned in this press release here, just based on my own analysis and my own research here. So hope you guys appreciate that. Of course, if you do, please hit the like button, right? All right. According to the MBA's senior vice president and chief economist, he stated the following. The news that job growth and wage growth continued in September is positive for the housing market as higher incomes support housing demand. However, though, it also pushed off the possibility of any near-term pivot from the Federal Reserve on its plans for additional rate hikes. So given the fact that wage growth and the jobs report was actually came in a little bit hotter than expected. That's fueling expectations for more rate hikes from the Federal Reserve. So take a look at this. This is according to investing.com for their Fed rate monitor tool. So if you actually Google their Fed rate monitor tool, it'll take you to this website right here. This website right here provides a forecast for what the Fed's going to be doing with the federal funds rate, so for rate hikes. So right now, the federal funds rate right now is at 3.25%. So going back right now, the Fed's going to be meeting in 3 weeks to share what they're going to be doing with their next rate hike. So that's on November 2nd. So right now there's an 84.5% probability that the Fed is going to increase rates by 75 basis points from 3.25% to 4%. And look at this because last week that percentage there, or the probability, was only 67%. Now it's just under 85%. There's also only a 15.5% probability that the Fed's going to increase rates by only 50 basis points. And fast forward to December 14th, the last meeting of this year, they're calling for a 58% probability that the Fed's going to increase rates, or the federal funds rate, to 4.5%. And that would be a 50 basis point increase if the Fed's going to increase rates to 4% back in November. Obviously, the significance regarding the Fed increasing rates is that it has an indirect effect on mortgage rates. So when the Fed does increase rates, that could increase mortgage rates, which of course could cool off our housing market even further. Let's go back to the MBA's report here because they also report some interesting trends regarding refis as well as ARM activity here, or adjustable rate mortgages. It says here the refinance share of mortgage activity remained unchanged at 29% of total applications. So out of all the applications for mortgage loans, approximately 29% are coming from refis, which is kind of eye-opening to me. I would assume that would be a lot less. Also, the ARM share of activity, which of course is our adjustable rate mortgage share, that activity decreased to 11.7% of total applications. Now, here's the significance regarding this 11.7% figure here, because at the beginning of January, the share was about 3%. So in other words, this share of applications for ARMs, or adjustable rate mortgages, is nearly 4 times the share from the beginning of January when it was only 3.1%, as I noted right there. So going back to January 12th from the MBA here, this is for the week ending January 7th of this year. So going back then, the ARM share of activity was only 3.1% of total applications. And here's why, or here's one of 2 reasons why. Number one is because the average 30-year fix, according to the MBA for this week here, was 3.52% at the beginning of January this year. For ARMs, or 5-1 ARM, it was 3.03%. So in other words, the spread between a 30-year fix and a 5-1 ARM was about 50 basis points. However, though, look at the spread right now as of today, or as of last week. Going back to this more recent report here, October 12th, look at this. The average 30-year fix, according to the MBA, 6.81%. But look at 5-1 ARM. 5-1 ARM, 5.56%. So the spread between a 30-year fixed and a 5/1 ARM is very, very wide right now because it's a lot cheaper, or you get a lot lower rate for a 5/1 ARM right now versus a 30-year fix. In fact, the spread, as I noted right here, is 1.25 percentage points between a 30-year fix and a 5/1 ARM. And of course, that's versus a 0.5 percentage point difference back in January of this year. So that's why we're seeing this huge increase of applications for ARMs right now. Again, up nearly 4 times the share compared to January of this year. This is also very close to year-to-date highs. The year-to-date highs was around 12% for ARMs that was set approximately 3 months ago. And here's something else I want to share with you guys as well, because going back to this report here for the week ending January 7th of this year, so the beginning of this year, the refinance share of mortgage activity, in other words, applications for refis back in early January of this year, was 64% of total applications. So approximately 64% of all the applications for mortgages were coming from refis. Approximately the remaining was coming from purchases. So 64% back in the beginning of this year compared to 29% this last week. And again, obviously that makes sense given the fact that mortgage rates have been increasing about 4 percentage points from 12 months ago. And lastly, the average contract rate for jumbo loans, meaning 30-year fixed rate mortgages for loan balances greater than $647,200, increased to 6.25% from 6.14% 1 week ago. And by the way, this is paying points of 0.61 in order to get that rate read, by the way. For an FHA loan, for a 30-year fixed FHA is at 6.61%, and also for a 15-year is at 6.12%. And again, these are just average rates for people with exceptional credit. On top of that, it's also for people with 80% loan-to-value loans. In other words, if you're buying a house, for example, this is assuming you're putting down at least 20% in order to buy the house. So with that said, please comment below with your biggest takeaways from today's video. Also, if you guys got any value in this video whatsoever, then please hit the like button. I greatly appreciate that. Hope you guys have an awesome day and look forward to seeing you on the next video.